James Bevan, Chief Investment Officer at CCLA Investment Management. Good to see you this Monday morning, James. Is it a self-fulfilling prophecy now? The markets are looking pretty awful, and it doesn't seem to matter what the policymakers, the politicians say. It all seems to be discounted in the markets.
Well, when you say it's fully discounted, I do think that actually many prices have fallen way below what is genuine fair value. And we have masses of uncertainty. It's very clear that policymakers not really grappled the imbalances. And I guess that there is a concern that actually all the rhetoric's currently about Euroland, but the real detail is the global picture.
And that is all about growth, or rather the lack of it around the...
I'm afraid it is, and policymakers have not yet demonstrated they really understand the nature of the challenge, nor do they have an adequate means of measuring what they've got to do and then implementing it.
Now, you've been in this game a long time, man and boy, James.
Quite right.
You've also been looking at the VIX index, the volatility index. Now, what are you gaining from that? When looking back at it historically, what does that tell us about what sort of things...
What I find really fascinating is the huge uptick in volatility, and yet the relative underperformance of big cap companies relative to what I would expect, given the sort of conditions that we observe. And I think that when one looks at the fundamental underpinnings of big cap, one sees relatively safe conditions in terms of credit spreads, decent dividend yields, good quality balance sheets, all sorts of things investors should look at.
Well, we can see the screen, it's on the screen now, the volatility index, and my goodness, what a volatile graph that we can actually see there. It is.
Extraordinary.
And from what you're saying, then, when large cap companies tend to outperform when lead indicators fall?
Absolutely, and we've not seen that happening, and therefore I think this is an absolute moment for people to say, look, do I really want to be in the small and mid cap names? Maybe I should look at the good quality blue chip big cap names, many of which are really very cheap.
So what do you favour? The likes of what?
Microsoft, Intel, Coca-Cola most definitely, the big drug companies like Novartis, companies where there is real transparency in terms of what they're making, but also in terms of the quality of their balance sheet.
And how much sort of dividend yield is coming on those? How much more important is that these days?
I can see a very large raft of companies that offer higher dividend yields than government bonds, but also free cash flow yields that are funding those dividends and allowing us to be very optimistic about future dividend growth.
And so what are you out of favour on then? What are you worried a little bit more on?
I'm really very nervous of some of the small caps which are relatively high risk, stretched balance sheets. Those are the sorts of companies where I think investors should get out their slide rule, be very, very careful of the downside risks that many companies now show.
These smaller companies actually, they could rebound if there was an uptick in M&A activity, which...
It's fascinating, isn't it, that M&A, as a matter of history, has been most focused on the bottom 20% of corporate performance.
And some of these stocks are looking incredibly cheap.
Well, when you say they look cheap, I think what one has to be very clear on is that if you were a corporate buyer, what are you trying to buy? You're trying to buy decent assets, decent franchises. Those companies clearly have a future. I think there are plenty of companies, however, where sales lines are fragile, where one would think strategically that a corporate buyer would think, maybe I can grow this myself, maybe I don't need to make an acquisition.
When you're looking for decent returns, decent assets, maybe we should be looking further afield. We had Morgan Stanley saying, you know what, if you look at some of the companies in emerging markets, looking at their value, they are the ones to go because their dividends and their prospects are looking far, far, far better than anything here in Europe.
When I look at the recent underperformance in emerging markets, particularly in Samsung Electronics, as a company which I think is very capable of delivering very strong shareholder returns over the next decade, investors have basically thrown in the towel and said, no, we don't want to be there.
And so just a final thought from what you've heard. We've had finance ministers coming out at the weekend, including George Osborne, saying, look, we've got a time frame of 6 weeks to get this European crisis sorted. It would appear from what we're seeing so far this morning, this rather gloomy Monday morning, that the markets aren't going to give them that much time.
Well, I think everybody accepts now that Greece is going to have to default. The sort of return to competitiveness is required in order to be able to stand shoulder to shoulder in Germany. Implies they're going to see a recession of around 7%. They simply can't balance their books on that basis. So I think Greece definitely defaults. The question is, can it be made orderly? I think the euro can hang together. And I do trust and hope that policymakers can come to the table with proper solutions to problems. If they don't, game over.
James Bevan, always a pleasure. Thank you very much indeed.